Welcome to an episode of Wealth Beyond Numbers. I'm your host, Dennis Coral. I'm the founder of Coral Wealth Management. I'm a wealth advisor and retirement planning expert. I bring over 20 years of experience. And the purpose of this episode is to educate about credit, educate about the importance of credit, tell you what is credit, tell you why is it important, why it should matter to you. And at Wealth Management, our interest is to provide advice and solutions to our clients as they build their retirement, as they transition to retirement. And I found doing this in 20 years that there's areas of wealth that are just as important. Credit is one of them. Credit allows you to purchase homes, access to credit cards, allows you to purchase cars through loans. And having a basic understanding of credit can help you, empower you to make better decisions with your money that are just as important as getting better results with your investments and your retirement plans. So I'm excited to introduce our guest for today. His name is Chris Colston. He's been a credit advisor for the last 25 years, so he has a wealth of knowledge and wealth of advice, and I'm happy to have him here. He's also a personal friend. So without any further ado, Chris, thank you for being here.
Thank you for having me here.
No,
Dennis.
it's my pleasure. I've always been trying to provide a lot of value to our audience in areas of topics of finance, and credit is just one that is so important, so critical for people, for Americans as they build wealth. And that's why I wanted to invite you here. You have so much experience, and thank you again for being here.
You're welcome. You're welcome, Dennis. It's true what you said. Credit is so important. And one of the main reasons why credit is so important is that the United States of America runs on a credit system. So if your credit is not up to par, and what is par, then you get punished. So that's why everyone, even if you're, making $20,000 a year or you're making millions of dollars a year, you need to know how credit works. Because if you don't know how to play the game will play you. And that's where you lose money. That's where everything starts costing you more money. And then if it costs us money, we're not building wealth. We can't plan for retirement. Then we're going to be 70, 80 years old, working a 9 to 5 and never have anything for ourselves because the game played us.
That is true. I've known you for many years, so we've worked together. You transitioned to build your own company over the years. And in the past, people needed credit to buy a car. Well, they still do.
Yes.
To buy a car, to buy a home. And the average credit score, I think, 700, is that correct?
718 right now.
718? So it's moved from 700 to 718.
Yeah.
And what's considered good credit?
So, all right, I'll give you just like school, right? Let's say a C average, a B average, and an A average, just so that our listeners and ourselves can understand how the credit works. A 640 credit score is considered a C average.
Okay.
So you're barely passing, but you're there.
Okay.
A B is a 680.
Okay.
And an A is a 740.
Okay.
But that is a basic A, though.
So 680 to 730 is a B.
A B.
And then 740.
740 and above is an A.
It's an A.
Now, where I would love, where I thrive to put on my professional clients to a score is I want them to be an 800 plus. But I want them to have a very strong 800. Because once you get to the 800 level, Dennis, you become the 1% of the 1%.
Okay.
Not many people have an 800. So you can leverage that to the fullest.
Okay. So between 740 to 800, that's considered like what you said, an A. And then double A, I guess, or A plus
A
would
plus,
be
plus.
800
to 850.
850. So for people that think that there's a 900 credit score, that doesn't exist. 850 is the highest.
It's the highest.
And why does being in the 1% in the credit space, in the 800 space matters? Why?
Because banks, they need to lend money. That's the job of the banks. They need to lend money. Mm-hmm. But the banks are risk adverse, right? They're only going to lend to someone that they know they're going to get some of their investments back, right? Even money related or interest related, right? So they're going to get money. Now, when a bank lends money, they need to have a great portfolio of clientele. Mm-hmm. So now, the greater their portfolio becomes of those 800, those million, $2 million, $3 million deposits, the bank becomes wealthier. Now the bank really is thriving forward and can lend more money and becomes more exclusive. So that's why banks need customers like yourself, Dennis, because they need to showcase, look, I may have 100 clients or so-so credit or so-so deposits, but then I have a Dennis, then I have an Eric, then I have a Brett, then I have a Mike. That those are the big whales, and that those whales are gonna carry the bank and it's gonna recruit other whales to come in. So that's why it's so important to have clients in the 800, because 800 means that you have great
credit history
patterns. You know, you have great patterns. You're good with money. You're good with saving. You're knowledgeable. You have a business. So they want those clients.
Okay. And for our audience, what makes up your credit score?
Man, see, that right there is a loaded question. What makes up a credit score? Debt.
Okay. Your debt. So
Debt.
debt is one of them. Is your history as well that makes up your credit score?
Yes. But debt is how much money has someone given you? So the way I like to explain to my clients, Dennis, is that if you have a friend, how many favors is that friend willing to give you? 1,000 favors, so $1,000 credit limit, or $30,000 credit limit equaling 30,000 favors, right? The higher the favors, the stronger your friendship is with that person. The more trust, the more belief I have of you and with you. So when that gets input into the credit report, now you look like a very trustworthy individual, right? Trustworthy client. Because now you're looking like, wow, that person trusted Dennis for that amount of money, that amount of favors. He must be really good. I want to be friends with Dennis also.
I see.
So the debt helps you out a lot. And I'm not saying debt like debt that you owe. Is what you have access to, right? Money you have access to. So that helps out. But going back to what you're saying is the age of credit. How long you have had a credit card for, or how long has that credit been open? So going back again to the friendship route. How long have you and I been friends? 10 years, 15 years, 20 years? So now we have credibility. Now we have a history of friendship. We know how we are as a person, as a business owners. We know that. So now you're willing to take a little bit more risk with me as the same that I do with you.
I see.
So you want to have friends that are very old friends, Dennis, but you also want to have friends that give you a lot of favors. But here's where people get in trouble. They abuse those friends.
So somebody has a $30,000 line of credit, and instead of using $5,000, they use the full 30, and then that hurts them.
Yes.
Okay.
And
in what way?
Now it's showing too much debt to credit ratio.
Debt to credit ratio.
Debt to credit ratio.
What is that? What is debt to credit ratio?
So it is the percentage of your usage on the favors, on the money that someone has given you.
I see.
So now if you are over 25%,
25%
of the credit limit, your credit score starts.
to diminish.
By 20 to 40 points, Dennis.
By 20 to 40 points on your credit score.
Your credit score.
So by staying under 25%, that's actually amazing information that you're sharing to our audience. It helps your credit.
Yes, and it helps your credit because it showcases how financially savvy you are.
I see. So to make it oversimplify this, I have a $10,000 line of credit, 25%, that's $2,500. So I shouldn't use $2,500 in a month, in a quarter, in a year, or revolving, or not exceed that on a month-to-month basis.
You should never exceed that in any day of the calendar year.
Oh, wow.
Any day. So it's not, so I have clients, then it says, okay, I have a $10,000 credit card. I used the $10,000 and I paid off that.
Oh, I
And
see.
now your credit score is dropped.
I see.
So if you always keep it at that 25% or lower, you will always maximize your credit score every single time. It will always be at optimal.
I see.
So I have a trick though
What's the trick?
that I give all my clients. Instead of paying your credit card every 30 days, right? Every month. That's what normal
Correct.
people
You
do.
get a bill every 30 days.
We have been duped, the new word, duped, on doing that. And it's a trick. The reason why they do it every 30 days, Dennis, is because they want you to use that plastic for 30 days. Remember, when you use a credit card, the money is not being taken out of your bank account, so you're not feeling it. Mm-hmm. You feel it when the bill comes in. Mm-hmm. When that bill comes in of 30 days of you swiping, the bill's so large that most people are unable to pay it off right away. So now they surpass the 25%, debt to credit ratio.
They're also paying interest now, high interest.
There you go.
And that's how they make money. The banks make money on that.
You pay the 29% interest. So they're hitting you from both sides. So one of the advice that I give my clients is instead of paying that credit card just once a month, you pay weekly. Have a relationship with your money, Dennis. Mm-hmm. Have a relationship with your credit. Because now if you know where your money is going or how you're using your money, you can control it. Mm-hmm. So if you pay weekly, you're like, oh my God, I went crazy. Right? Like, usually when I have my kids over, for the weekend, Dennis, and you and I are fathers, so we can understand this. Like, I'm getting my kids tomorrow, and they'll be with me from Friday till Tuesday. I know I'm going to spend money. Right? I have a 16-year-old and a 12-year-old.
Of course.
We're going to spend money, and it's college football, so it is crazy. So then I know that next week is peanut butter and jelly for me. Because
I hear you.
You can't spin out of control all the time.
Yeah, you want to spoil them.
But you can only do it if you know how to budget yourself, if you have that constant relationship with your money and you're seeing how much money is coming in per month, Dennis, how many clients hired us, and what are we spending?
Yeah.
And how we're spending it.
One of the things we do when we work with our clients always, as we start our relationship with them, is we make them do a budget. So we have an Excel spreadsheet that we email it to them, and we tell them if they're a couple, if they're married, or they're just in a relationship, we tell them you should do it together. Because by you doing it together, both of you know your numbers. So typically, sometimes in a relationship, one person's in charge of the finances and the other spouse or partner kind of defers that to their other person. So by doing them together, they have clarity on where their money goes. And by doing that, we can kind of start drafting a plan, drafting the next side. And I'm very adverse to debt. I always tell our clients, you shouldn't have any debt. You shouldn't have any credit cards because what is the average credit card rate now?
29%.
29%. That's really high.
That's crazy.
It's crazy.
It's ludicrous.
It's ludicrous. Yeah. We're living in a period where interest rates are high. Therefore, credit card interest rates is high as well, 29%. So that holds you from also saving. Yes. And one of the things when I work with clients at the beginning is I ask them, do you have any debt? And I help them pay off that debt before they even start investing with us, because they're not going to make a return on their investment of 29% in a month or in a year. They could get it in a year if we have high markets, but by them paying off their debt, it's as if they're making money. Because now they're going to basically make 29% of money that they were putting in a payment plan over time that they would have probably take them years to pay it off. So once we pay off a debt for our clients, then we can start building and saving for investing. But credit is important. Yeah. Because if in the future they do want to buy a house, they do want to buy a car, or they want to refinance, the banks that they're going to look for the loan, it's going to look at their credit score. So that's why we're here.
So you're a therapist also.
Well,
you're saying all this, and he's a therapist.
We look at the overall finances of clients. We don't look at just the investments, just the retirement plan. We really look at a more holistic way of how to help clients.
That's the right way, though.
Yeah, and you and I have worked together. You actually have helped me in the past because I am in the financial services industry. I have to have good credit. I cannot have good credit, not have poor credit and provide financial advice.
Yeah.
And it doesn't make sense.
It doesn't.
And I always had good credit, but I always wanted to make it better than what I had.
You're
And
proactive.
Yes, and you've helped me in many ways, and you also have taught me a lot of different tips that I want to also share with our audience. So one of them is to do not spend 25% of your credit limit. So if you have a 10,000 line of credit or a credit card limit, don't go over 2,500 on a year in a year.
No, and on any day. So the way I
On
do
any
it,
day.
any day.
Throughout
day.
the calendar year.
Throughout the calendar year.
So then another tip that I guess we could share with our audience is then request a higher credit limit increase.
Yes.
Can we talk about that?
So I love that trick. So a credit limit increase, you can actually ask your credit card company, right? Twice a year. So every 6 months, you can get a credit limit increase. I like to do it once a year because when I do it, Dennis, when I suggest it to my clients, I swing for the fences, right? I want to better your credit. I want to better your status as quickly and as rapidly as possible, but also by showcasing your muscles. Let's say that $10,000 credit card, right? That we're using as an example. Usually people will be like, can I get a $2,000 increase or $5,000? No, let's get a full 100% increase. Let's get a $10,000 increase. So now we're going to make that credit card from $10,000 to $20,000. And customers ask me, Chris, why do I want to do that? That sounds crazy, right? Like I'm going to have more access to more debt. Yes, I'm very, very careful to who I say this to, Dennis, because it can be a very big rope that, you can tie yourself with. But showcasing that you have a higher credit limit, that you have more muscles, stronger muscles, that people trust you with money, increases your credit score. Because in a credit score, the way the credit score generates a point, right? The points is an algorithm. And the algorithm checks a couple of variables. One of the variables is who is giving you that credit? Which company? Is it a company, and I don't want to say names, right? Is it a company that is known for clients with bad credit, associated with clients with bad credit? Or is it a company that's associated with the A-list?
Okay.
Now, if you get associated with those companies associated with the A-list, you get more points because the algorithm is picking it up.
I see.
Now, also, they shows that I believe in you, that A-list companies believing in you. But here's the other spin. They want to see how much you're using, how much you're consuming, and how do you repay. So ability to repay is very important.
And when you mean ability to pay, you mean pay off the card in full?
Yes.
At the end of the month or whenever the bill?
Yes.
Okay.
I actually have a client friend of mine as well, financial advisor. He went through a very serious situation, a divorce a couple years ago. Very smart. He's always been very smart, but curveballs hit him and we needed to help him. He is so meticulous now that is crazy. I'm like, Paul, how do you do this? Anytime he buys anything, Dennis, let's say right now we're going to go have lunch afterwards. Let's say we go and pay for lunch. Let's say it's $100, right? Nice lunch.
Okay.
He pays off that credit card that same day. So let's say he consumed $100, $500 a day. He pays it off the same day. He's like, I'm not going to allow what happened to me before happen again.
Is it because he's worried about the interest he's going to be charged?
Or he's worried about a curveball that may hit that he never saw before, right? And then he got into trouble.
I see. That's when you budget. That's why it's important
but
to
now
budget.
he budgets daily.
I see. Got it. That makes sense.
So he has like a daily budget that he uses and he pays it off right away.
That makes sense.
So his credit card bills, like the balance on the credit cards, never change because whatever he uses, he pays it off. Whatever he uses, he pays it off. So if you pull his credit any day, he will have optimum credit.
Gotcha.
Because he's not carrying debt.
That's amazing.
Yeah.
I think that's a great way to end this episode, because the next episode I liked us to discuss trends in the credit advisory world. And I hope you can stay, because there's so much information that you're sharing now and so many tips that we'd like to share with the audience. So we'll leave that for the next episode. Okay. But that's amazing. And we're going to follow up on the next episode on that, because I want to dive in deeper.
Okay.
I hope you enjoyed this episode of Wealth Beyond Numbers with a special edition about credit with Chris Colston. I'm Dennis Coral, your host. This is Wealth Beyond Numbers. And as we like to say at Core Wealth Management, retirement and financial confidence starts here. Thank you.